Good afternoon, everybody. My name is Mark Ross. Thank you to Marine Money for having me here. I think it's the second time I'm moderating a panel, so they have me back, so hopefully I don't embarrass them too much. Maas Capital is basically an alternative financier as well. We are a big equity provider and debt provider to the market. More of an equity house than we are a debt house. We span the entire shipping segments. We do business across the globe, and we cover shipping, as I said, offshore and in intermodal markets. So we're quite, we have a good view on basically on the debt as financiers, and also how to say attracting debt as owners of vessels. We have interest in about 95 to 100 vessels in total across the shipping and offshore spaces. So that's a little bit about us. I want to start on the other end of the table. If anybody give the panel a chance to introduce themselves and give a short summary as to what they do and where they do it. I know there are players here that are advisors, and then others are also, how to say, balance sheet players on the alternative finance and equity side. Please.
Great, thank you very much, Mark. Mark Teng here, I represent SeaKapital. We are a relatively new outfit, although our founders have each had 30 plus years of experience. I myself was at the bank for 25 plus years, and we, like Maas Capital, we are also a provider of both private equity and, in some sense, private credit. We are involved in approximately 20 vessels, with new buildings and secondhand tonnage across all different sectors. And our founders, when the company was first formed, firmly believed that shipping is a long-term commitment. It's a very large capital-intensive business, very diversified on the supply side, and exposed to global risks in every sector. So the way they thought about it was, rather than thinking about cyclicality or even counter-cyclicality, they invest in a certain acyclical thesis where we can invest in both finance and operating leases. We have title to the ships. We, of course, obtain back leverage in terms of senior secured debt, something we're very familiar with. And we try to obtain a shareholder's return that is above the market, so-called. So that's a brief introduction, and happy to be here in this 16th panel.
Thank you, Mark. Nicholas?
Hello, everyone. I'm Nicholas Petrakakos. I'm a partner at Alantra's shipping team. We're an investment bank with offices around the globe, about 25 offices. We run the shipping practice out of Dubai and Athens, which are our core markets. We have been advising clients in the past 5 years, both on the debt and equity side, and we've raised about $4.5 billion now, including with a few of the participants in this panel. And yeah, so we are the guys that are between capital and demand and supply for capital.
Thank you, Nicholas. CK?
Yeah, the name is Kwek. I work for Neptune Maritime Leasing. We're a private credit provider. We're backed by a group of Greek family offices. Today we have a portfolio of about $750 million, 52 ships. We're active in both commodity shipping as well as in the offshore space.
Captain?
Yeah, thank you. My name is Dutt, and I'm heading a small tanker owning firm. So nowhere near the numbers which my colleagues mentioned. We just have 3 ships and 2 under construction. And I realize amongst this esteemed panelists, I'm the only borrower. Rest everybody else is a finance provider. And the other distinguishing point is that I think I'm the least financially educated as well. So, which has its pros and cons because when you don't drill down too much into say a transaction, things probably are a bit clearer. The tanker markets have been pretty good for the last 3 years. While we have access to somewhat expensive alternate financing, we don't find it a problem now with these strong markets. Thank you.
Thank you. I'm going to come back to this particular point, but we're also a borrower at times.
Hi, good evening. My name is Kaizad, doctor. I run Dynamis Capital alongside Frederick Ulstein here in the audience. I must say, without you, we wouldn't be in business, so it's nice to have borrowers on the panel as well. Dynamis Capital is a sale and leaseback platform. We predominantly are capital providers. We provide sale and leaseback solutions to borrowers. It's a global mandate. It's a diversified fleet. It's a very young fleet that we currently have. Just by way of a bit of a background, we were spun out of Oaktree Capital last year. We had a brand under Oaktree which was called Fleetscape, which was set up in 2018, so we're not new kids on the block. We've been around. To date, we've done about over $1.6 billion of gross capital allocations. We have a young fleet currently. We have new builds on that we're adding to the portfolio. Average fleet age about 2.5 years, diversified fleet. I would say a healthy mix of containers, tankers with backlog, etc. We pride ourselves on being counter-cyclical providers. Everybody says that, but we actually are firm believers that if you stay disciplined in this market, you're going to have longevity. And then the good thing about us is that we treat our banks and borrowers as partners. So we see a lot of repeat business from our existing clients, and we have a very good relationship with the banks. So we can talk about bank retrenchment later in the Q&A. But I think, yeah, we are here to grow. We are here to stay. We are here to service the right owners. And shipping is extremely fragmented. It's a global mandate, as I mentioned earlier, and capital intensive. So the only way is up.
Thank you.
Thanks, Mark. My name is Rajbir Talwar. I represent FPGM Capital. I do have to make an observation. It's very disconcerting looking at yourself in the reflection there, I have to say. Maybe that's something from a design point of view they should change. But getting down to a little bit more serious business, I represent a subsidiary of a firm by the name of FPGM. Some or many of you might know them, predominantly Joko financing, and Chinese sale and leaseback arrangement, and a few other good businesses. As for me, the FPGM Capital setup is about 4 years old. We are Singapore-based, Singapore-licensed fund manager, predominantly focused on maritime and aviation as an asset class, and we try to develop products. Because we're not that big, we also fundraise ourselves. We develop the thesis, we deploy the capital, and we get the capital back for our investors with some good return, hopefully. We've launched our first fund about 9 months ago, and we're in the process, fingers crossed, and if you can finger cross with me, very close to launching our second fund.
We'll cross fingers. So, gentlemen, I think there's been advisors, there's borrowers on this panel. Over the last couple of days, so yesterday is today, Joachim also again presented that the Norwegian market, bond market, is also kind of like a huge competition now to alternative, so to say, financier providers. Statements that we've heard over the last couple of days is that it's just a good time to be a borrower. So I'll come back to you, Captain Dutt. But how is it then for you as financiers? If it's a good time to be a borrower, does it mean that you are under pressure with margin as financiers to the market? I'll give it to Nicholas first. I know you're an advisor, but...
Yeah, of course, happy to take a shot at that. We've seen in the past 2-3 years a complete change in the financing landscape, if you will, which shows what exactly you say. There is, of course, competition. There has been a bit of shakeout, if you will. We had some exits from the sector altogether, especially from alternative financiers, which is the topic of this discussion. We've had banks coming back quite aggressively, including European banks and mostly, let's say, domestic banks like Greek banks, German banks for borrowers within their territory. And we hear mostly from them that there is quite a bit of competition on the margin and that they need to shrink their margin to gain more business. We don't see that much on the alternative financing side, where besides the shakeout and, let's say, the less players that are in, we haven't seen, let's say, an improvement in margin per se, because still the projects that you guys are looking at still are a bit not down the middle path. So there is demand for more, for faster capital, for more flexible capital, which still comes at a price, regardless of how the rest of the market prices.
How do you see this development?
First of all, we are lenders, but we are also borrowers.
I understand.
So the margin compression can be, and the bank back leverage is a significant portion of our cap stack. So that is advantageous to us. Second thing is what alternative capital providers provide is speed, flexibility, and a relationship. You have us on the other side to pick up the phone in case there's something you need to talk about. So as I said, 70% of the origination comes from within the portfolio. Once you have a relationship, just for diversification alone, people could choose us. And the third thing is that you need to move with the cycle. So where are we in the cycle? 3 out of the 4 elements are up. As they say in real estate, it's about location, location, location. In shipping, it's about attachment, attachment, attachment. There's no fourth here. So for us, it's a decorrelated market. Unfortunately, 3 out of the 4 segments are at historical highs. But if you look around, there's plenty for everybody. It's a very fragmented industry, and the banks are chasing the top-tier names. But so the middle 80% is underbanked. And if you look at the bank retrenchment, there is a monotonic decline. So if you know where to look, you will find the right borrowers, and you will develop the relationships, and then you will be able to grow.
Is it a fair statement to say that we are, how do you say, fishing around the fringes of the market, as opposed to, how do you say, where the main banks are, going after the top tier clients?
So let's do this in numbers. Why are we, at least as alternative capital providers, in business? The reason why we're in business is IFRS 9 or Basel 4. Now, some banks are late to adoption and some banks have adopted it earlier. But there's a monotonic decline in bank lending. If you look at Petrofin's numbers, it's 290 billion of Western bank lending. And if you normalize the fleet from 2011 onwards and apply a regular growth, there's a funding gap of about 380 billion. Mm-hmm. So there's a gap that exists. The decline is structural or secular or monotonic. And you should not extrapolate, because if you see the last 2 years, it's flattened out. So the banks are here to stay. Obviously, banks are our partners as well. But if you now take the entire funding market as a pie, banks are about 65%, Chinese lessors 15%, and we can come to that in a bit. You have alternative capital providers as just 5%. So it is truly in the fringes, but it's growing, because there is a monotonic increase in the trend. A lot of our friends out here on the panel as well will see growth. And then finally, we are talking about the bond market. Bond market waxes and wanes. I saw the previous session. But it's not here and doesn't have a monotonical trend. It's just more of a, it's there, it's about 11%. Okay. So while the banks retrench, we are here to grow, and that 5% can turn into 15%. But on a $2 trillion market, there's plenty for everybody.
CK, what do you see? How do you see this market? I know I've traveled, I've gone to, how to say, let's say, more exotic locales to meet potential borrowers, and I've met you there. So how do you see this market developing?
Yeah, we have a very similar business model as Dynamis. So we are also a borrower. So for every transaction that we write, we will need back financing from the banks. So margin compression could also be useful for us. We see over the last 12 months, our portfolio has doubled from 26 ships to 52 ships. So we're still writing transactions. Margins are coming down, but we're also getting better terms from the banks that are providing us with back financing. So we're still able to deliver the returns that our equity providers require.
Mark, care to weigh in?
Absolutely. Echoing what Kaizad and CK just said, we are also borrowers as well as lenders, and we also observe margin compression, and our philosophy is if you can't beat them, use them. And who we thought originally were our competitors in this space, we ended up leveraging them for a better return to our own shareholders. It used to be the case that 25 years ago when I first started, that if you wanted to buy a ship, you went to a broker, or you could choose a new building yacht in Europe or Japan. Now the situation is very different. Instead of calling the top 10 banks, which were all the 10 banks that did ship lending, specialized lending, you have so much more choices. Not only the top banks, which, despite what Kaizad said, even though they're on a downward trend, I think they're still very committed to the business. And I know for a fact that they're also trying very hard to draw in local banks and smaller banks that are starting their ship finance outfits. But still, I think yesterday we all heard the statistic that 20 to 25% of financing done today is Chinese leasing companies, right? And we know where that's headed. But for us, I think we are the real catalysts in this, rather than on the fringe, as you mentioned earlier. I think we are here to kind of bridge the gaps between certain leverage requirements or maybe decarbonization requirements that banks, through Basel IV, through Poseidon principles, whatever internal constraints that they have, we're here to help. We're here to bridge that gap between what the banks can offer and what the real industry needs.
So, interesting point you make. So basically, is it that where the banks are not providing the capital to the industry that, to the needed capital to the industry, that's where we add value? And is it only in availability, is also speed, or what's the value? Where do you add value to your clients as opposed to a more traditional bank?
Well, absolutely. Again, echoing what Kaizad said, speed, flexibility, structural options. We're here to talk about all of that. We look at shipping risk the same as everyone else. We look at counterparty risk, we look at asset risk, we look at cash flow risk. And where one is greater, well, then we can discuss the others, right? So what we offer our borrowers is not only a one-size-fits-all approach, but who else can we find as partners in this space? Nobody works alone in this global industry.
Yes. Captain Dutt, you mentioned that you're the only borrower on the panel here. The statement before was that it's a great time to be a borrower. Do you agree?
Absolutely, and as Dr. and other panelists mentioned, what we look for is speed and certainty and flexibility. So the banks, as you mentioned, take 50%, but that's a totally different segment, at least from our perspective. Typically, a bank would look at a huge container line, 10, 20,000 TEU dual fuel ships, each one priced at $200 million or something. For us, we are looking at older ships, second-hand ships, where you're trying to execute the purchase as fast as possible to ride on the market. Our criteria and requirements are obviously different from a very large entity. So, yeah.
Yesterday as well, I heard, and I think it was a dry bulk panel, that at the end of the whole discussion the question was, okay, so you have a lot of financing options available to you. So what's your preferred option for financing yourself? The answer was traditional European banks, like we're talking about the old school, shipping banks that most of them are not even there anymore. But they're coming back. In Greece, we see a whole lot of banks actually providing leverage that is actually, we haven't seen in a long time. So if the preference is every time for that type of leverage for their projects, how do you differentiate yourself? How do you?
Yeah, maybe I'll take a stab. I think we have some other colleagues, amongst others, CK, who I know from when, who have been banking before and now, let's say, represent alternative. So maybe we can take a stab a little bit on, kind of opening the banking kimono, even if I'm not opening my own. Banks are, at least the ones that you see still around, I think are here to stay and an extremely important part of this industry. They're driven in our business a lot by relationship, a lot by wallet size, a lot by counterparty risk, of course, and they've got a regulator to deal with. And the regulator is not an easy regulator. So they are limited, not from the fact that they're doing something wrong, but they're limited by certain ways and means that they can do transactions. Folks that most of us represent here, albeit I work for a regulated fund manager, so don't get me wrong, have a little more ability to be, dare I say, creative. And that creativity could be, I know there's certain other members in this panel who could probably turn a term sheet around in 2 days. I know from my banking days that was a bit more difficult. There are people who can give you a committed response within weeks. From my banking days, I know that's a bit more difficult. We, for example, fund manager, we are developing products which has kind of a blended finance structure, so we can pull in catalytic capital into products where we can share risk that a bank can typically not share or is not allowed to share. So I think if I would sum up my response, I think creativity is something that is afforded to us moreover than to a bank.
Yeah, to add to that, Kaizad said before that there is a monotonic decline in bank financing, but if you isolate the top names, it's probably increasing. So the top names go more to the banks. They have access to the banks that they didn't have before. We've seen a lot of the larger issuers replace Chinese leasing with bank financing. So that particular piece of the market is very well covered, and of course the banks are having a killing there. They're also in the forefront of decarbonization financing, new technologies and everything. So again, from an assets perspective, you're talking about ships between 0 and 3 years old that are very well designed for that sort of financing. For everything else, you need something more spicy, let's say. Not only on the asset side, but also on markets. There are markets that banks won't touch. Offshore is a market like this. And most of the alternative guys here have invested in offshore because banks are not there to invest. And it's not regulatory. It's the fact that they've been burned in the last 10 years, or they don't like the volatility, or they just don't need to do it because they're lending to Hapag-Lloyd at numbers they like. So it's a lot of dynamics within how value is created from alternative financiers. And I think if you look 5 years ago, some of the guys that were sitting yesterday at the dry bulk panel, they were banking with very high cost of debt capital, and now they
I know they were.
Yeah.
Some of them I know that they were at very, very high margins, and now, I mean, the liquidity is back. That one bank is struggling, is falling over the other to throw you a term sheet now. So the market has really changed. I mean, we've also gone from being equity investors that we had to really shop around and be really friendly to some banks to get leverage, to now it is actually relatively easy to. But to go back to your point, that particular market that basically is underserved by the banks. And we've talked a lot about shipping, markets being high, prices being high, nobody be wanting to engage it as you were buying because if the prices are too high or new building prices are too high as well. Offshore. Are you seeing a big shift of your book from the traditional commoditized shipping into more specialized or offshore segments?
I can take that. About half of our exposure currently is in offshore space. But that tends to be the more liquid part of the offshore assets, the OSV and the anchor handlers. That said, we're also looking at projects in other more exotic offshore assets like lift boats and accommodation vessels. Mm-hmm. But typically always with long-term contracts and on a full payout basis. We're not there to take residual risk because valuation in offshore space tends to be binary. There's a value when there's a contract and it's scrap if there's no contract. And we choose our client very carefully. We like to work with people with long track record, ability to remarket the assets at the end of the existing contracts.
I would say the same. I think add a couple of things. So I think you want to kind of segment yourself into the more liquid asset classes with longer backlog. And you need to make sure that these contracts are not cancelable. So you need to go into the weeds and check out what the asset is, what the end user really wants, and whether there's longevity to the asset.
Are you any of you also participating in the offshore market, but in the European markets, as opposed to only Middle East or Asia Pacific?
European preferred. Middle East, you need to be a bit more selective about who you deal with because it's nichier. European, at least, you know what the end users require, you know what the supply dynamics look like, you know what the demand dynamics look like, you know what to avoid in terms of the UK sector, in terms of the retrenchment from the oil and gas companies, etc. So I think UK dynamics are a lot more visible. You're also very well serviced by the Scandinavian banks who know everybody and see everything. Yeah. And there's a lot more data available. Middle East, you need to know who to call and what their backgrounds are. So at least for us, we'll be a lot more competitive. Never say never, but we'll be a lot more competitive in Europe. And then, of course, US is difficult to access.
Yeah. Nicholas, I know you are more operating on the Middle East segment and more towards the east as opposed to North Sea type of assets. Care to weigh in on this as to why, and do you see the differences that?
It's part chance and part effort on that. We've been in the offshore side since 2019 through restructuring back then of a certain portfolio, which probably saw the last banks that were investing in the sector get out, local Middle East banks. Since then, the market has changed completely. I feel a bit different than Kaizad feels about Middle East, in the sense that there is, of course, much visibility there. It's a market that you deal with national oil companies. You don't deal with oil majors. So you can see they have they need to pump oil to fund their budgets, not just profitability. So they run the business for revenue more than they do for profit, which acts as a volatility dampener, if you will, on earnings. You won't make as much as in the North Sea, but you won't lose as much either. Of course, you have different personalities, let's say, in the Middle East. It's an industry, and it's not its infancy, but it's maturing more now. You get more independent operators than you would get in the North Sea. But again, you get more standardized assets also. It's a market that on that side has matured. The local banks are starting to invest on the top names, as all local and national banks do with their local names. But there is still a lot of activity on the independent operators, which is akin to what alternative finance is offering. Is a market that needs studying, not only in the Middle East. In general, market and understanding market is not something that banks are willing to do if they can make the returns elsewhere. And for most banks, shipping is just part of the book. For alternative financiers, it is the book. So you need to understand the markets. You need to invest time in meeting people and learning how they run the business, and then you invest. Banks need a lot of time to do it, and usually lose the cycles with new markets. So yes, Middle East is something we live and breathe in the sense we've done probably $1.5 billion on equity and $1 billion on debt on that market, and we only see it growing.
Good. When are we looking at a deal together? When are you showing me a deal?
We're going in November. You should come.
No, it definitely forms part of anybody's book. There has to be a certain sector allocation when it comes to offshore because it's extremely cyclical, it's illiquid. But for the right counterparties, to Nicholas's point, with the backlog, with younger assets, without too much residual risk, because who knows what's going to happen in 5 years, I think it's definitely the way forward.
I mean, from Maas side, we've also taken up a lot of offshore exposure. I mean, that's where most of the business we've done over the last couple of years has been. I agree with you. I think somebody was that you need to know your partners much better. You need to really dig and use the flashlight, know the corners to actually before you can do a transaction. But do you see because there's been much talk as well about MSI forecasting markets. There's been much talk about talking about is it going to be a segment that is going to be higher for longer, or do we see a fall coming? How are your views on the market going forward? CK, you look like you want to say something.
Well, I think we all watched MSI's presentation yesterday with the usual level of interest, where they have that chart where, you know, it's, and that's all fine and good. I mean, we look at the global market, but one thing that I've learned after joining this segment of the industry is that it's highly idiosyncratic, and you don't really just, you can look at each individual sector, and oftentimes we go out and explain shipping or preach the gospel of shipping to the world, and you remind people that, you know, it's not all container ships, right? Even though that's all you see. Each segment has its own cycle, and once you're actually in the industry and you talk to the people, and you know, you're not just sitting in a desk at a bank, you realize that it's really deep, and you need to talk to the local participants in a certain industry, geographically and also sectorally. So I think it's hard to pinpoint specifically, because the more you talk to people, the more we also realize there are a million ways to skin a cat. You can have a 15-year-old Cape, and you can still operate with a proper CII, and with certain energy-saving devices, and with the right crew to avoid detainment at ports. And there are just so many ways of generating profit, but you have to have the know-how. And one thing that we bring to the table when we talk to banks and also borrowers is that we put our money where our mouth is. We establish trust on both sides, and hopefully we bring a little bit of our own expertise and introduce the right people to the right projects. So.
Let me add a little bit to that. I think it makes sense. We are credit, at least we are credit. We are not equity. So I'll tell you where credit ends and where equity starts. It has historical minimum asset values, okay, with the cash governance. Anything above that is equity territory, here be dragons. So with that caveat, you also need to kind of de-lever. So in case you stray above historical minimums and you detach at above historical minimums, that means you need secure cash flow to bring you back to a safe zone. And that's our philosophy. Second thing is, you can use the MSI's forecast because it's the tool that the industry uses, our banking partners also use, and it's extremely valuable. At the end of the day, it's your capital. Yes. So if you stray above historical minimums without the right corporate guarantee, without the right cash cushions, without the right protection, then you'll be dragons. That's the first thing. Second thing is shipping has got the lowest, shipping is decorrelated basically. So talking about idiosyncratic risks, macro, it's actually a positive for shipping. So if you talk about decorrelation, if you have a diversified portfolio, the maximum correlation between the 10 different subsegments is about plus 10.1, which means that if you have a diversified portfolio, I mean, you're more or less getting into a safer zone as you grow. So these are the structural protections that you have within shipping. So what do you have? You have corporate protection, you have the right attachment, you have probably good cash flow, and then just keep an eye on your assets, right?
I like the term you use, attachment, and attachment, like you mentioned. I agree it, follow it. Yeah. This is, that's your lifeblood. So we have a lot of, risk. Anybody else that's doing equity investments in shipping here, other than Capt and Dutt, you're owning vessels?
Yep, that's right. So, yeah, doing well. So we are looking to the day when we'll be fully levered out, hopefully before the life of the ship ends.
One other theme that I heard over the last 2 days is that basically that a lot of the, green agenda that the banks have been holding on to, and talking and spreading the gospel, so to speak, that now that, they're retreating a little bit from it, now that they're looking for more profitability, so they're letting go of this gospel. Have you ever had this type of, target or goal in your mandates in terms of,
So, sure, I'll take this one, thanks. We are probably one of the only funds who actually have a decarbonization trajectory, and we give a better margin reduction to the borrower in case they beat the trajectory. We are not signatories to the Poseidon Principle. We probably will not be. In terms of bank retrenchment due to decarbonization, if the banks sign up a voluntary Poseidon Principle, then they are beholden to the decarbonization trajectory. Now, unfortunately, those very banks will not be able to service their existing clients because the vessels are slightly older or stray into the wrong band in terms of decarbonization. We, on the other hand, if we are serviced by those very banks, then the banks may take a view on our aggregate fleet. And mind you, my fleet, we have 14 vessels with mega engines. Average fleet age is about 2 years. So our carbon emissions are significantly below what is required. So I think we have several devices. We also want to do well by the planet. So while we are not beholden to a particular regulation besides what the regulators impose on the fleet, we do want to do good, and we have several devices within the portfolio. In the past, we've also financed scrubbers and other fancy stuff, but I'll let Rajbir take that one.
Just to be clear, we don't have a particular mandate. We're not a decarbonization fund as such or a fund manager. Having said that, now on multiple occasions, we've been focused on that sector. Not necessarily to do good, I think that's great, but from what we've heard from investors is, listen, guys, that's nice to have, but there's a certain minimum we need to have. You're gonna keep the lights burning, right? So what we've tried to do is look at that as an opportunity and then work on that. So I kind of alluded to it a few minutes ago. We're actually now very close to launching our second fund, which will hopefully help ship owners reduce their CO2 footprint using a leasing methodology whereby we will share the risk of energy efficiency gains or losses, for that matter, or not enough gains, let's put it that way. And it will be a first of a kind. So before I make it zero of a kind, so I'm going to keep my mouth shut so I don't jinx it. But the idea is, can you make money out of that? Of course. So I think we should not look at, let me put it another way. I think till 3-4 years ago, it was an ideology. And now I think it's reality, right? So if you guys have been in the VC space and so on, you got this valley of death. We're now hitting the valley. I'm not saying of death, but hitting a valley. You're coming from the high point where everyone's talking, green or whatever else. But now you're coming to real, dollars and cents. And when there's no push from the back to say, I need to do this, then you really has to make a good business case. And I think that's a great starting point. And I think that sets us up very nicely, try and develop on the back of a certain return an investor wants, irrespective, whether it's green, brown, whatever color. And then to the other end, I go back to the creativity. By the way, we are also, for now many years as a firm, not FPGM Capital, but my parent institution, an investor in Prow Capital, which is a very well-established European fund that runs the Green Shipping Fund. And then the ideology was the same. It's not for, they're not cheap capital, they're alternative. But they structured it in such a manner that they could still provide capital to battery ferries, to vessels that support the wind farm industry, et cetera. So I think you can find ways to use green, but yet make some money out of it.
I applaud it. Nothing is sustainable without it being financially sustainable first. So that's our motto as well. So okay, I'll wrap it up. You all have, large lending books as well, your financiers. When things go wrong, what's the difference between you and the traditional kind of like hatchets that the banks would use? Do you manage it differently? Do you approach it differently? I want to hear from everybody.
Let me take this one first, because we have some experience in the past, and it's about. This is a general analogy. Debt, equity, don't run shipping from a spreadsheet. It's a bad idea. It might look good on a spreadsheet, but the reality is completely different when you want to get your hands on the collateral, etc. So in a past life at Oaktree, we had an issue. We took care of the issue, but it's to do with the ecosystem and knowing your assets. Captain Dutt sailed. There are lots of people who have tons of experience. I've sailed. When you have to take over, you do not arrest a vessel. You have to have something that is consensual, be mindful of the asset class. So in summary, it's basically to do with the ecosystem that you live in. At Oaktree, we had like several shipping portfolio companies we could rely on. I could call in favors. Right now, we have an even better ecosystem going for us. Plus, you have friends. So you should know who to call. You should know when to do what. And, do the right thing quickly. Run into the fire in case there's a problem and it doesn't become a bigger problem.
And again, knowing your partner and knowing the attachment angle you're talking about.
you have to have a conversation as well, because things can go very badly wrong if you don't move quickly as well. So,
Exactly.
yeah.
But I think in reality, it has not been tested for alternative financiers, right? Most of the alternative financiers have been in the game from 2018 onwards. So a sharp correction
but
on
Nicholas,
a portfolio basis has not been tested. Maybe on certain
Nicholas,
occasions.
selectively. I mean, portfolio basis, I would say not, but selectively
But then you
it
see the
has.
correlation goes to 1, right? When 2008 happens, when 2014 happens, you see correlation going to 1, and then it's not as easy as knowing your partner. So I think it's one part that it has not been tested on a portfolio basis. But what we have seen as advisors only in this situation is when there are issues with payments, with delays, etc., alternative financiers are more relaxed, let's say. Because at the end of the day, you guys have a view, have an equity view, really, although you invest on the debt side. And in some cases, you can wait. If there are compelling reasons to do so, and of course, coming back to knowing your partners and trusting them, etc. Banks have been less, let's say, accommodative in certain cases. And of course, the upside to the organizations is different in doing so.
But when you say that the less accommodating attitude that the banks would have, I mean, it's kind of like, I would say, sometimes shooting yourself in the foot, kind of like approach, no?
That
I mean,
is
I've seen there, I sat in restructuring departments in banks and seen the approach of, you know, just simply being, sorry, pardon, but just not being very smart in that approach of how to handle these things.
I feel we are talking about survivorship bias out here. There are people who are not on this panel, funds that are blown up, who had a problem. So I think we don't have the full universe
you need one
of...
problem in some cases to wipe you out, right?
True, exactly. It's a debt fund. So the maximum you're going to make is 1.4 times money. On a portfolio with 20 deals, if you mess up 4, you don't have longevity. So there will be no fund 3. So there's one thing called survivorship bias, but the second thing is with bank, it's more led by regulations. So you have to kind of close your position, because if you convert to equity, the capital charge is, well, not sustainable.
Yeah, but oftentimes the banks are, well, they have their regulatory and segmented approvals, and they take a long time. And the worst decision you can make is not making a decision in a fire sale scenario. Echoing what we talked about when we talked about the origination and structuring of transactions as an alternative financier, I think speed and nimbleness, agility is very important.
When you're structuring a transaction, are you always have in the back of your mind that it's structured for default?
Well, a lot of our deals, we are, in fact, the lessor, meaning the title holder, right? And that's a very different perspective than as a mortgagee. You have much more direct access to the security and the title of the ship.
Mark, I know we are running out of time, but one quick comment, again, putting my banking hat on from the old days, is also an adverse selection here, because a lot of the banks mostly focus on younger assets. And I think by definition, your training tells you, and I always say this, it's a volatile industry, what goes down also comes up. It's not only what goes up comes down. So I think, and I've been in situations where banks have acted really rationally. So I think to give them due credit, it's also, and our colleague said it, one of the ways to deal with it is to actually work with the client. So I think a lot of our training for people on this floor is coming from that kind of methodology. You don't have to have one trick for all. But if you have older assets, maybe that's a slightly different analysis in how you...
Absolutely. It goes again to your partner, and it goes again to the quality of the assets you have. If you're sitting on the wrong assets, not all will come back.
It is a wasting asset at the end of the day. So one needs to be very mindful about all the factors that you take into consideration, including the fact that the borrower can kind of...
it's steel sitting on salt water.
Exactly.
So I guess we're getting to wrapping up this panel. At least we had some discussion at the end. I like that. Thank you, everybody. One last question I wouldn't say for everybody, but I mean, if somebody has a view, in particular, then share it. In terms of how do you see us as a industry or a segment, and how do you see us developing going forward? Are we going to be, I mean, I call it fringes, but we're basically where the other traditional, lenders don't go, or, risk is too high, or jurisdictions are too tricky, or assets are just too old, and you have to be creative. Where do you see our value being added going forward? How do we see that?
I'll take a very quick one and then pass it to the rest of the colleagues. 20 seconds each, please. 10 seconds. Oh, no, 20. I'll take 20. I was once at one of these conferences trying to raise some money, and somebody said, not from our industry. We call ourselves alternative. They call us niche alternative. So we are from an industry which, we got a bit of an echo chamber here, but from outside, very difficult. What folks on this panel are doing is attracting outside capital as well. So I think that's one thing great about being in the alternative world, is you're trying to find ways in which you can sell what we all sell to each other on a day-to-day basis to others that are out there.
To echo that, how do I sell it to alternative, the pension funds, etc.? We asset-backed, decorrelated, and risk-adjusted returns. So I think on a bumper sticker, and Americans love everything on a bumper sticker, you can add private credit to that. So where do we evolve, to your question? We are a private credit fund with all these characteristics, which is becoming extremely fashionable now. So it's not that we are a niche in a niche. It's actually becoming fashionable because I can show you decorrelation in our portfolio and provide a pension fund that benefit. Well, they'll be concentrated in real estate or geographical concentrations, etc. So you can spin a positive on it as well.
Yeah, so as a borrower, I think from alternative capital providers, there's always a deal to be done. It's just the buttons and the switches. If it's too risky, lower the LTV. Front load the installments. That there is always some solution, and depends how confident the borrower is, he'll still probably go ahead.
Thank you. So I've spent time as a maritime banker, both in first line as well as a credit approval and as chief risk officer. Bank tends to be very pro-cycle, and shipping is cyclical. So I think increasingly private credit was not just filling the gap. If you look at the aviation industry, leasing is an important source of capital for the aviation industry. So I think we're here to stay. Good.
Yeah, I think the value that alternative financing is already providing to the industry is immense. It's not just replacement capital, it's additional knowledge, it's additional connections. It's a new ecosystem within shipping that didn't exist 10 years ago. It's certainly complementary to debt financing. It's also complementary to equity financing. And if we see auxiliary industries as aviation, it's not only leasing. Aviation is almost all of it is alternative financing, the way we describe it today. So I think in the years to come, the effectiveness of the capital, of alternative capital, will increase, not only for the fringes or for markets that are not touchable, but it will be an everyday tool for any ship owner that wants to expand their business.
Very optimistic view. CK. Sorry.
Well,
Mark.
I've just left the ship banking world after 25 years, so I'm definitely here to stay in this space. But just to reiterate, I think being open-minded about partnerships to fully explore the various idiosyncrasies in the global shipping market, being asset-focused, and also not being too greedy, I think is a good final word on this. Thank you.
Thank you very much. Thank you, everybody.
Thank you.